Howdy there, folks. Welcome into the four-piece here today. 4 videos for me to react to, give my opinions and perspectives on. First one up here is in regards to a bunch of economic data that just came out. Want to react to that, kind of give my opinions and perspectives on that brand new economic data there. Then we're going to get into this one. We see the S&P 500 touching all-time highs in mid-2024. Okay, JP Morgan. We'll hear what they have to say. Then I want to react to this one. We've been big believers in the secular bull market, says this person out of B of A. So I want to hear what they have to say about a secular bull market. And the last one up here, in some ways, the Fed is fighting the federal government to get inflation down. That should be a very intriguing one. So a little macro discussion there. So appreciate everybody joining me as always. Thanks so much for being here, folks. We are about to hit a new all-time high subscribers literally tonight. So I appreciate each and every one of you being here as always. And let's get into this.
Yes, from the Conference Board, our September reads on consumer confidence. Expecting a number a little north of 105, a disappointment here at 103. 103, that's the weakest since May when it was at 102.5. Some revisions, some good revisions, though, for last month are going to help. 106.1 moves up to 108.7.
Yeah, so definitely not something you want to see. That's bad news is bad news. Type situation there, right? Where, if consumer confidence is waning, that definitely doesn't bode well for the overall economy, right?
Present situation, 147.1, that's the best since July, but keep in mind, July wasn't that long ago. We just had a lower read in between, and last month's lower read, 144.8, moves up a bit to 146.7. And finally, what lies ahead? Maybe the most important of all, 73.7. That's the weakest since May as well. Now, let's look at new home sales, shall we? New home sales, 675,000 seasonally adjusted annualized units. That is the weakest since March, and that follows a 714,000 that was upgraded to 739,000, which still keeps it at the best since February of last year. And before we go to Diana real quickly, Richmond Fed Manufacturing breaks a record of 16 negative months in a row with a positive 5 business conditions. Turns back negative at -5, which means 18 of 19 are now in negative territory. And for that very close but still disappointing new home sales number, Diana's going to give us a little bit more granular detail. Diana?
Before she gives detail, I hope everybody's ready. I hope everybody's ready to see the numbers that are going to come out this winter when it comes to home sales. Get ready to see just a complete disaster when it comes to home sale numbers during the wintertime. Oh my gosh, is it going to be brutal? Absolutely brutal. I'm looking at these sorts of interest rates that we're likely going to be facing in the wintertime, and winter's just a slower time period in general for the housing market. Oh my gosh, just get ready to see those numbers. Ooh, man, are those going to be rough. And by the way, they better hope interest rates turn around by springtime. Whew.
Well, Rick, it's all about mortgage rates. Look, these are signed contracts. That's how new home sales are counted. Signed contracts in August, and in August, the 30-year fix went well over 7% and stayed there, and that's what's hitting new home sales down 8 points.
Yeah, the problem is now mortgage rates are even higher than they were in August, and quite a bit higher. Look where we were at the beginning of August and for the first few weeks of August, and now look at where we're at. Oh, gosh.
7% month to month, still up nearly 6% year over year. I'll note that the median price was $430,000. That is down 2% year over year. So the builders are clearly trying to lower prices to offset these higher mortgage rates. They're also buying down the mortgage rates as an incentive. We've heard that from the home builders starting to do that again. They had stopped doing that in the spring. Also, homes to a 7.8 month supply. That's up from a 7.3 month supply in July. And that just means that the builders have more to sell, which is better because obviously there's nothing for sale on the existing home market. I would note one number I love to look at, which is the homes that have been sold but have not been started. That have been pulling back, but it's actually rising now again. The builders are up against all kinds of issues with labor and material delays and costs, and they're saying that it's harder for them to build more homes. So they still have high supply, but when you see that number start to go up, you have to say, okay, they're selling a lot, but they're not able to build them. So again, a disappointing number for August, all based on higher mortgage rates and affordability. And I'll just say today that yesterday, the 30-year fix went over 7.5% for the first time in more than 22 years. Sarah, back to you.
Okay, so that economic data we just got there, okay? One side of it, you could definitely look at it as say bad news is bad news, right? obviously home sales continue to drop, and it's going to get probably worse before it gets better in regards to that situation, right? Which less real estate activity usually is a damper on the economy. And obviously, consumer confidence dropping. You don't really want to see consumer confidence dropping, especially going into the most crucial quarter when it comes to consumer spending, which is the fourth quarter, right? You don't really want to see consumer confidence coming in weaker than everybody expected. So that definitely gives a little, a worrisome sign. I mean, heck, how can you be that confident from the consumer side when, a friend sent me a text earlier. He's in LA right now, and showed me the gas pump. It was I think the cheapest grade was $6.54. $6.54 was the cheapest. Like, that's just ridiculous, right? And so stuff like that's going to wane on consumer confidence. Now, on the flip side, then data we just got there, you could look at that very good. And here's why. You could look at that and you can say, well, if consumer confidence is waning, that's good because maybe we can finally kill down this last leg of inflation. If housing's slowing down, maybe we can finally kill down this last leg of inflation. If the market's weaker, commodities are going to weaken, and that can help kill down this last leg of inflation we're dealing with, right? Which this last leg is a hell of a one to deal with, right? We're in the CPI in the 3s right now. We need to get that baby down to 2s. And so that's what the Fed's looking at, and we've got to kill inflation. Like, until we kill inflation, we can't get out of this kind of high interest rate cycle we're in. And obviously, if you look over the past 100 years, it's not a high interest rate cycle. But if you look over the past 20, 30 years of modern economic times, we're in a very high interest rate environment right now. And so we can't get out of that until we kill inflation. So that's why you can look at these things as negatives or positives. I think 2024 is going to be more of a year where bad news is bad news and good news is good news. But for this year, it's actually kind of a funky year. You could look at those things we saw today and actually look at it as potentially good news that economic data is coming weak, because you don't want a hot economy right now. Hot economy means hotter inflation. Hotter inflation means Fed has to stay higher for longer.
Odin, a global investment strategist at JP Morgan, global wealth management. I was searching for a word to describe what we've seen for the past month or so after that move off the October lows. We're in a backing and filling or something more substantial, more significant.
I think some of the volatility is just a little bit of concern about, lately we've heard this idea about recession again.
Yes.
But if we look back to, the Fed meeting and their SEP, it does seem more like the soft landing is very much in play for them. It just seems like the market's a little concerned that it's possible that, they could potentially go further with rate hikes, although it does seem like a Goldilocks scenario when you look at the SEP.
Yeah, and shouldn't they be happy that their SEP says soft landing, or are they, oh no, it's going to be a soft landing, we need to do more? That's the paradox that we always find ourselves in with the Fed. They haven't done enough because they haven't slowed the economy.
Well, I mean, you even heard Jerome Powell, Chairman Powell, sort of allude to it, right? The economy is still very strong, growth expectations rising. The consumer doesn't seem to be too fazed by higher interest rates, and I think that's where the concern sort of comes in. Does a soft landing turn into sort of a no landing scenario, and then in that scenario, does the Fed have to raise rates higher? And then if you're in that scenario, do you then move into a recession? So I think it's almost like we're getting closer to what's the next phase, and then how does the Fed navigate rate cuts, or do they actually get to cuts before hikes?
What do you think? Will there be more hikes in your heart of hearts? Do you think
I think we've seen the last of the hikes that we've seen in this cycle. Yes, I think rates are fairly restrictive at these levels. We've seen disinflation. If you look at some of the forward-thinking measures on inflation, what's coming out so far for September, using some of the spot prices, you're seeing further disinflation in that core services, that more sticky inflation. I think expectations are around 4.1% for September. And so we're seeing that continue to move in the right direction, although oil prices somewhat of a concern in that how that impacts headline inflation, but we believe that's short-term in nature for now.
Well, but then you worry about whether there's really in the system wage increases on the horizon. And we've got unions still aren't, 8%. They've been rising a little bit, but from low levels, that in and of itself probably couldn't add to wage inflation. But if it's a manifestation of everyone wanting more because of inflation, then you think that could turn into one of those spirals. I need more money.
Well, to be fair, I think we're kind of already in the spiral. like why are we acting like we're not in a wage price spiral potentially right now. Okay, when I look out there, what did we just watch in that last clip? The home builders can't get enough workers. Okay, if you can't get enough workers, what do you have to do to even try to attract workers? You have to keep paying more and more and more. You have to pay more and more and more to hope, can we get a worker here, okay? So you have that going on. Obviously, we know the auto worker strike, the Hollywood strikes that have been going on, right? We had the UPS situation. You had all those dynamics. Workers want more and more and more, right? Because they're having to deal with more and more and more when they go to the grocery store and everywhere else for the past 2 years. So now they want to try to play catch up here. So I almost feel like we're already in one of those spirals when I think about just my city, Las Vegas, and the amount of workers we need. I mean, my gosh, we need 6,500 workers for the new Fontainebleau Resort. We need like 1,500 workers for the new Durango Resort. We need a massive amount of workers for the F1 race. It's in November. We need a massive amount of workers for the Super Bowl, which is in February. And never mind that, plus all the construction projects that are going on and the home building. So we need a lot of workers in a lot of different areas right now. And so I can make a pretty strong argument that we're already in the wage price spiral situation. It's just a question of how long do we remain there. My thought process is it begins to start to fall apart in 24. And by 25, you're completely out of the wage price spiral. But that's my opinion.
Prices go up because they're paying more and then they need more money to pay for it. I mean, we've seen that movie before.
Yeah, average wage growth is around 4%, and I think 3.5% is typically indicative of the 2% inflation target that the Fed needs to get to. But to your point, there are a few headlines out there that are concerning to a certain extent how that's going to have an impact on the long term. Obviously, the Fed pushing out to 2026 a little bit further is a bit concerning. And so we'll see how that all plays out. But I think some of the headlines, there are pockets here and there, but also you're hearing about a lower quits rate as well as layoffs. So how that offsets will be interesting to see how it comes out in the data in the next couple months.
So suddenly 2024, we're not sure that's going to be a great year for S&P earnings growth. Is it going to be the rebound we've been looking for after a flattish year?
I think we see the S&P 500 touching, all-time highs in mid to 2024 at some point. And I mean, that's the soft landing base case, because at some point you believe the Fed's going to pivot and markets should rally from there. Earnings, we've seen positive earnings revisions over the last, month or so. And for us, consumer discretionary looks poised to actually perform quite well as the Fed looks to pivot. I mean, if you look at 88% of the S&P 500 consumer discretionary companies all beat expectations. And so in the soft landing or the softish landing, we see that the S&P 500 continue to push higher.
So it's possible that rates don't go up enough for multiples to contract. So let's say multiples stay where they are, and then earnings grow 10, 12, 15%. Then it could be reflected in the price of the stock.
Yes, definitely. And I know there is still that concern of a contraction and how that's ultimately going to impact earnings. If we do see stronger, resilient growth, and I believe in sort of a no landing scenario, then you could see somewhat of a contraction. But right now, I feel like the data is telling us that soft landing is very much in play, and from there, you should start to see higher levels, or at least us being able to reach those all-time highs again on the S&P 500.
I mean, stocks aren't just as far as multiples go, they're not cheap.
No, they're not. I mean, but if you do back out that magnificent seven names, and we've seen a bit of narrowing there, and the equal weighted is at 16 times earnings as opposed to 19 or so when you're looking at with the Magnificent Seven. So some of the air coming out of there is room and valuations across the board.
But then those are the ones you might want to own because they will grow.
Oh no, I mean we're not saying not to own them. I just think that you can get some of that bounce back and a little bit more bang for your buck if you're looking at the equal weighted and starting to look outside of those seven names. I know a lot of clients love them because that's sometimes how they got to where they got in their portfolio, their concentration there, but there are other opportunities outside of the seven for sure.
So gold or Bitcoin? If you did Bitcoin, would Jamie come and see you?
Okay, before we hear gold and Bitcoin, okay, what's my opinion on S&P 500 hitting all-time highs by, let's say, mid-2024? There's always a range of outcomes and probabilities that could happen in any situation, right, in the markets. But I think, if you could get the soft landing, and let's say the economy doesn't really deteriorate in any massive way, I think you could get there. My mindset's going a little bit I'm a little worried about Apple. We're hearing some exciting stuff about potentially demand for the new iPhone. I don't know. I'll be convinced when I see the Christmas quarter numbers and when I see the spring quarter numbers. But because I'm just not hearing exciting things like on the ground, but I don't know. And obviously Apple's a worldwide company, so maybe, people in other countries view it very differently. Maybe they're super excited in China and in the Middle East and wherever about the new iPhone. So that's something considering. Microsoft's trading a little rich right now. It's not super overvalued, but it's trading a little rich. So kind of worry about that one a little bit, because if you're thinking about all-time highs, you really got to think about like how you're going to get there. It's the biggest weight companies, right? Meta has a long way to run over this next several months, so I think Meta can run. Amazon and Google have the government hangover that they're going to be dealing with here for a bit of time. So I think it's a possibility. I really think it's like a coin flip, to be honest, in terms of all-time highs. I don't think it's in the bag. I also wouldn't go against it. Remember, it's not like we're that far away. How far are we in the SP 500 from a new all-time high? Probably in the 5 to 10% range. It's not like it's a mountain to climb that's like, holy smokes, how are we going to get back there? It was a much harder challenge at the beginning of this year. Now it's not nearly as much of a challenge, right? So that's kind of my opinion and perspective on that. By the way, I'm going to move this party inside because that sun is starting to beat on this computer. Woo! Alrighty, let's hear gold or Bitcoin.
AJ, Ixnay on the Bitcoin Bay.
Very good.
Yeah? Nailed that. You know what? I'll comment on. We were just talking about James.
You sell it in some funds, though, I thought, now, don't you?
When it comes to when we talk to clients about, because obviously clients want to be diversified, they want to grab onto the newest technology. I think we haven't seen enough when it comes to the history about allocating to sort of crypto in general. But we tell them, obviously we can't advise on allocating to it, but don't put any more than you're willing to lose into that positioning. And then obviously you look at some of the regulatory headwinds there.
So if you're talking to a client about it, do you go like look around and see if Jamie's?
No. We do have a target on gold, and I think a lot of portfolios need to be diversified at the end of the day. So having
gold's held up, but
yeah,
God, it's been at 1900 forever.
Forever, yeah.
Not really, but
it seems like it.
Thanks for having me.
It has been 1900 forever. Oh boy. Okay. Alrighty, next one up here. We've been big believers in the secular bull market. B of A. What do they have to say?
So what the charts are telling us, Stephen Suttmeyer, Chief Technical Strategist at Bank of America's Global Research. And I feel a little better after looking at your notes, actually, Stephen. So not to worry, seasonal corrections occur during this time. Nothing that you see right now tells you it's anything more than that, and an upward trend could resume in the next good time, which begins in November?
That's correct, yeah. So if you follow seasonality in the market, you typically have a summer rally, into July, August. So, and after that, you typically get the fall correction. So the second best 3-month period of the year happens to be June through August. The worst 3-month period of the year happens to be August through October.
Are we through the worst of it? Is there more to come?
Yeah, good point. When I'm looking at some of the tactical sentiment indicators, we do have some important support levels that we're at now, right around 4,300 on the S&P. But when you look at something like the put-call ratio or the 3-month VIX versus VIX, they're coming down, but they're not climactic yet, meaning not enough near-term fear in the market that was associated with past lows in the market. So I actually think the low could happen below this 4,300, maybe towards 42, somewhere in the 42 handle, with those indicators triggering, meaning 3-month VIX versus VIX below 1. That's the fearful reading. And the put call, 5-day put call, for instance, somewhere in the 1.12 to 1.25 range, which is where it occurred March, December, October, and June of last year. So I think we got a little more on the downside here.
I know it's been a while, but we never retested October lows, and we never got a capitulation or any of the things you just said.
Yeah, to get the VIX to spike in any sort of substantial way is a freaking challenge. And here's why, okay? Why can we not see, or why is it going to be very difficult to see a VIX 30, 40, 50, something like that, right? Here's why. One, if you're talking about a situation where the economy starts to deteriorate a lot, right? And I don't think it's happening over the next few months, but let's say it starts happening in early 2024, right? And you see job loss, you see the economy deteriorate, you see major slowdown in spending. Let's say some sort of situation like that. Well, a lot of people are going to welcome that because that means inflation is finally going to be done for sure, right? 2, that means the Fed's not going to be higher for longer, and they're likely going to end up cutting because we know as soon as you see some real economic problems, the Fed's got to start cutting rates, right? That's what they do because then they start worrying about employment. So you have that scenario, and then if the economy stays okay, I don't think people are that fearful of the Fed raising one more time. What's a quarter point going to do? It means nothing in the end. So that's why I think it's really hard to get people really scared right now, outside of some sort of event happening that no one saw coming. Outside of that, either side of that is not that scary because of what we've been going through, and it would be seen as welcomed on the other side. You also have the economy start to deteriorate in 2024. People say, oh, rates are going back to zero. It's going to be the next business cycle starting. Let's get it on.
We never got at 3,600. So now you're talking about 4,200 as being the intermediate term low, and you just totally took those old lows that everybody was looking to retest. Why didn't we ever have a capitulation that time?
Well, I think we did for a few reasons.
Duration, not a quick one, but a U instead of a V?
Well, I would argue this. First and foremost, we had a low in June of last year, and you retested that low in October. So that was a retest, but you did get some capitulation. One, the 3-month VIX versus VIX did get below 1 right around that time
frame.
The
VIX never got above 20.
Yeah, the VIX is very strange, right? Okay. It's not really working the way it used to. So that's why I use that ratio, 3-month VIX versus VIX.
Yeah, I heard that.
And the other thing that was very interesting about last year is that when you look at AAII bears, they got above 60 in late September, around this time last year, which was
I remember that. It was the week of September 21st, if I recall. I remember that.
Level that's seen since
that was
2009.
So if you looked for it, it was there.
It was there. And, we wrote about it at the time, and, everyone kept saying we didn't get capitulation. I'm like, you got it from these two indicators, not from the VIX.
You should have called me, because I was waiting for someone to say that we didn't need a capitulation. I had...
What do you need, a written invitation? What are we talking about here? This is a problem with the market, man. These people, and all these people, retail, they all got caught up into this crap, man. We just saw last year the greatest companies in the world fall 50, 60, 70, 80%. Netflix's, the Shopify's, the Amazons, the Metas. Go through the list. Tesla, you could go through the whole list, and you saw those stocks fall 50, 60, 70%. Guess what? Every time you see the greatest companies in the world fall like that, it's capitulation. It's time to buy. It's time to load the boat, okay? And if you don't do that, you're just missing out on a ridiculous opportunity. It's like these people need a written invitation. Now dividend stocks are just being stupid. There's a capitulation going on in dividend stocks right now. And people are going to choose not to pick up dividend stocks. And then they're going to look back in a few years and be like, why was I buying that stock at that price? It's just, I don't know, man. It's such an easy game to me. And people just don't know how to play the game. That's what I'm convinced. People literally don't know how to play the game. The game's so damn easy. And I don't know if people are blind or what's going on. It's crazy.
You got it. You just didn't get it from the indicator most people are looking for it in, and that is normally what the market does.
So you don't see credit strain, or you don't see any of the scary things that would indicate that this is more than just a correction?
At this point, no. I mean, if you look at the option-adjusted spread on high yield, it's not expanding aggressively.
But thank you. You do.
That's a good one,
That's why you're here. What is it?
The option-adjusted spread on high yield, high-yield corporate bonds.
Not this morning.
It's quite low. It hit a new cycle low earlier this month. And then corporate BAA to 10-year spread's another important one, right? I mean, that one's below 2. When you get above 2.5, that's a problem. And it recently just hit another cycle low, right around 1.7 or so.
How quickly do those metrics change when you're getting into a bad time? And we've been talking about how the economy looks great until all of a sudden it doesn't.
Right.
How about those metrics?
Yeah, when the dollar weakens, that's certainly going to be if you want to talk about something that's bullish for stocks, when the dollar starts to weaken, that's going to be very bullish.
Is that the same thing? It looks great, but it can fall off a cliff?
Well, the beautiful thing is sometimes these indicators do have divergences. So if we were looking at late 2021, for instance, a lot of the indicators we're talking about now actually had their best levels, bull market levels in the summer. Mm-hmm. And right now they still have their best levels here. So there's no real divergence at this point. But if all of a sudden a 1 standard deviation event turned into a 2 standard deviation event, you would think it would show up in these credit spreads. But I mean, again, the market has a cyclical uptrend. And if you keep it really simple, 40-week moving average around 4,200, that's the cyclical trend right there as a guideline. Secularly bullish as well. We've been big believers in the secular bull market. Maybe we're getting towards the later stages of that, but the big level to pay attention to there is that 200-week moving average right around 3,900. Now, it's not unusual during these seasonality periods, and it's happened on past pullbacks over the last decade or so. 200-week moving average, right?
Really? Hot pastrami? Dude, that's such an East Coast thing. my parents from the East Coast, man, they always love eating pastrami sandwiches. So random. West Coast, I don't even think people know about pastrami. Hot pastrami, that cracks me up.
900. Now, it's not unusual during these seasonality periods, and it's happened on past pullbacks over the last decade or so, where you go down and test the 200-day, which a lot of people look at, but I look at the 40-week because, I like to eliminate the daily noise, and that would argue that a perfectly normal thing to happen in a bearish seasonal period is to test some of those longer-term moving averages.
So he's got the technical analysis gene. Apparently, was your mother? You have 2 copies of that, or?
That's so funny. So, anyways, yeah, the technical analysis, folks. Like I say, in regards to technical analysis, right? My opinion of that is, I'm not a personally believer in technical analysis. I think everybody that watches my content, that, right? I'm fundamentals based, and that's about it. I don't care about anything about 200-day moving averages and all that crap. But what I will say, a lot of people do. And so when there's a lot of people do, you just got to understand stocks can move based upon these different technical, indicators. Let's just put it like that, okay? If some guy believes that, the 50-day moving average just got hit, so you got to buy this stock, and he's a big fund manager, it's going to push the stock up. Or he feels like he got to sell the stock, it's going to push the stock down. So it's just, you got to understand, no different than living in a neighborhood. There's going to be different people with different viewpoints than you. And you got to understand that they're there. Doesn't bother your progress or what you're trying to do. It's just you got to understand there's different people that have different views, and certainly in the stock market, a lot of people are into the technicals.
Jason Trennert is here, longtime friend of the show, so you probably do know who he is.
Long-time bear.
If you don't know, it's chairman and CEO of Strategas Research Partners, which is a Baird company. And Jason, you have been bearish for a long time. Your concern at this point is that it's higher interest rates that's really putting the pressure on the markets
listen,
now.
we got bearish last March of 2022. And I would say we stayed bearish this year, but largely I would say for the wrong reason, because we were expecting a recession. Now, we also, I have to say, we did expect, I do think inflation's sticky. I think there are elements of inflation that are structural, which means that long-term interest rates should stay higher. So we got that part right, but I have to say on the economy part, the economy is still, especially if you look at the labor market, you have claims at 201,000, unemployment rate still at 3.8%. So there's still tightness in the labor market, which is important for the Fed because that is a big input into the way they look at inflation and interest rates.
Well, look, we spoke with someone earlier who just pointed out that the JOLTS rate is not the same, that's seen some impact where you don't have people as willing to quit. And that's an indication that maybe the job market's getting a little tighter.
It should get tighter. It should get tighter because profit margins have been under pressure for 3 quarters in a row. I mean, one of the things that people have talked about, it's a theory, is that there's been some job hoarding on the part of companies, which is to say that despite the fact that profits have been down, albeit modestly, normally companies would lay people off if margins were under pressure. This time, it's been so difficult to hire people out of the pandemic that they're holding on to them. They're saying, like, well, gee, it was so hard to get these people in the first place. We're going to hold on to them. We're going to have to see real pain and profits before we let people go. Now you might be getting to that point where quarter after quarter, if that starts to happen, you start to make different choices.
So we definitely saw that. If you want to know the biggest place we saw that in tech, right? I mean, so many of these tech companies were just hoarding employees. That's the best way I can put it. And then obviously that changed massively at the end of last year. And we saw, a lot of that obviously change in a substantial way. So I don't know how much of that's going on in these American companies and businesses in general, to be honest. So
does that mean you are? You think that?
I think it was a much just bigger thing in the tech circle of Silicon Valley.
If we're getting to that point where companies are willing to actually start firing people because margins are getting squeezed, which some people think we are, second half of this year, is that good news or bad news? Do you want to see a labor market that is a little looser, and so then you don't have the Fed continuing to raise rates, and you don't have the same sort of pressure on wages? Is that what you're kind of advocating for? Is that good news?
It's tough because if you get markets don't do well in recessions. Okay, so sometimes there are profit recessions without there being economic recessions, but it never goes the other way around. If you have an economic recession, you always have a profit recession, and markets get tagged. So what you're hoping for, of course, is the proverbial soft landing where you slow it down just enough so that the Fed doesn't have to tighten that much more or it can actually start to ease. The issue, though, is I do think there are changes in the labor market and the global economy that mean that inflation could stay higher for longer, even if the economy slows. I think you've had an end to globalization, which I'm convinced is going to keep prices higher. You have environmental policies, that, in my opinion, that are keeping energy prices higher for longer. And then you have a federal government that's running budget deficits of 5 to 6% of GDP without any sort of idea of what the consequences are. And 65% of government spending is indexed to inflation. So in some ways, the Federal Reserve is fighting the federal government to get inflation down. And so even if the economy slows, the hard part might be that Fed funds rate stays high or that interest rates stay high. And that will be a challenge for investors. It does suggest that you want to be more towards companies that are providing profits, cash flows. You know, you want to stay away from the long duration assets.
The 10-year really is at 4.5 now. I just saw it is at above 4.5. So I'm trying to figure this out. You were wrong for the wrong reason. Does that make you feel better than if you had been wrong for the right? And if you were wrong about the wrong reason, does that mean you were right?
No.
Two wrongs don't make a right. So
right.
I'm confused.
No. I think, listen, the fact of the matter is, I have to say, Joe, I still think the chances of recession are pretty high. I mean, simply because I've never.
Well, it just means the Fed's got to even go further to cause a recession, which is still playing into your negative scenario.
Yeah, I mean, I think so. I mean, I think I would have expected to see one now, but right now, if you look at this thing called the Taylor rule, a very wonky thing, but Taylor rule would suggest if you want to get inflation to 2, you have to get the Fed funds rate to 8.5. Now, that's not going to happen because we're going into an election year and the Fed wants to remain independent and the Fed would be a department of the Treasury Department.
We want to remain independent, so we're not going to do what's going to make you mad, so that we're not going to do what we would like to do, which will make you mad.
I think you've been right for the wrong reason.
I've been right for the wrong. Maybe that's right. Yeah,
maybe
that's
what.
Yeah, I'll take it. I'll take it.
I think I wouldn't question that because you did say. I mean, I pushed you pretty hard. You stuck to your guns. You never. Through the tip.
Yeah, we're trying. You know,
well, it's not.
No victory lap here. No. We still got plenty to.
Yeah. So where did the recession call of 2023 go wrong? I look at it like this, right? Obviously, 2022 it was around March, April 2022. The Fed obviously started raising rates, and then they started raising aggressively. And usually, the Fed lags kick in 1 year out to 3 years out. So 2023, expecting the recession to hit, right? You're just a little early in the game in regards to that, right? You're at more of the 1 year mark. It's a much safer, I guess you should say, bet to be betting that the recession happens in 24 or 25 at some point in time, because then that gives you kind of more of that 2 to 3 years of kind of wiggle room. And still is not guaranteed. It's still not guaranteed. So if you're saying, oh, for sure it's going to happen in 24, for sure it's going to happen in 25, it's still not even a for sure thing. It's just a much higher probability. And remember, the whole stock market is a game of probabilities and outcomes. And there's a range of scenarios that can happen, right? And so I would just say there's a much higher probability the Fed lags catch up with us and hit us hard starting in 2024 and probably leads into 2025 a bit. That's just my best guess on kind of the odds and probabilities in regards to the situation. We'll see how it all plays out. There's so many different things could factor in. What happens if the Fed starts lowering rates faster than anybody anticipated? What if the election goes one party versus another party? And what if that party does certain things to help out the economy dramatically, like let's say lower taxes or something? You know, there's so many. That's why I say it's a range. People always want it to be one way or another. It's like, no, you don't understand how many things go into the economy, how many things can change, black swan events that can happen. It's a deep subject. I appreciate everybody joining me as always. Thanks so much for being here, folks. If you're looking to access my free workshop I put together for you guys, check out the pinned comment down there. It's a absolutely free workshop for you to access. It's Investing Foundations. It's a 5-day workshop. All the videos are free. You get a ton of value out of that. It goes over some very important subjects. Much love and have a great day.